Hey, everyone, and welcome back to another episode of the Recession Resistant Real Estate Radio. I'm your host, Brandon Cobb, and today I've got Marco Santorelli on the show. He is a serial entrepreneur, investor, author, Inc. 1000 entrepreneur. He's the founder of Norada Capital Management and Norada Real Estate Investments, the largest nationwide provider of turnkey cash flow investment property. His mission: he wants to assist 1 million people to create wealth and passive income and put them on the path to financial freedom. He is also host of the top-rated podcast, Passive Real Estate Investing. They've got over 500 episodes. Marco, welcome to the show.
Brandon, honored to be on your show. Thank you so much.
Oh, man, the pleasure is all mine. I'm fantastic. I'm excited to have you on today because I really want to dive into the subject of turnkey rentals. This is something that is really powerful when it comes to creating financial independence. But before we jump into, what you're doing today, for those that don't know you, give them a little context on your background and how you got to where you are today.
Oh, wow. Little context. Okay. Well, I'm a two-time Inc. 5000 entrepreneur. I'm an avid investor, both actively and passively. I'm an author. I'm a founder of multiple companies. I've been investing in real estate since I was 18 years old. That's kind of how I got into the whole real estate space, but I've been an entrepreneur at the same time in parallel to that. And then, I'm involved in many different asset classes, from cannabis to crypto. And kind of a fun fact side note, something I invest in quite a bit is Broadway musicals. So I'm co-producing 6 new Broadway musicals. One just went live December 4th. It was opening night for A Beautiful Noise, which is the Neil Diamond musical. So I'm involved in a lot of things, but yeah, I love investing. I love educating people and teaching them how to create wealth.
Okay. All right. I've got to take a pause here because that's really interesting. You're the first person I've met that invests in Broadway musicals. Before we go to the turnkey stuff, what is that like? Because I'm trying to think of, there's got to be a cost that goes into that. You've got to plan everything out, and then you've got to have some kind of like expected income, or I guess ticket sales associated with that. Like, run us through, what are the nuances of investing in Broadway musicals?
Well, it's high risk. I'll start with that. Out of 10 new productions, 7 will lose money, meaning you'll never recoup your original investment. 2, you will recoup your original investment and maybe make some money, and usually that's for a relatively short period of time. 1 out of 10 will not only recoup your original investment, but you'll actually make money, and in some cases good money, and sometimes for a very long time. Like, you look at shows like Hamilton, Wicked, etc. They run for many years, and so they have distributions or dividends that pay for a long period of time. One of my business partners, who's the lead producer on 5 of the productions I'm in, he literally says, look, if you're going to invest and write a check, pretend that you'll never see that check again, because your expectation should be that it'll be a loss and you're just supporting the arts. But it's fun. My daughter is into performing arts. She loves to sing and dance and act, and so it just resonates well with what I love, which has always been live theater for 30 years. So, but I look at it as an investment and a passion project. I enjoy it, and it's just part of the portfolio that's actually in my fund. I have an investment fund separate from the real estate side, so it's a separate business. But that's in that portfolio. So I've included all those productions as part of our company.
Very interesting. So it sounds like a lot like private equity and angel investing, where the majority, they're expecting to not recoup their money, but that one out of 10, that 1 out of 15, it makes up for all the rest plus a lot more.
Yeah, that saying, you don't really bet on the horse, you bet on the jockey.
Yeah.
So that's essentially what I'm doing. I love, you underwrite, you underwrite a real estate project. You invest in multi-unit, multifamily, you underwrite the project, right? So I do the same thing. I underwrite the show, I underwrite the whole story and the script and everything else, but I also look at who is running this, who's leading it. And that's the lead producer. And so that's the jockey. And so I'm betting on the jockey. And so I know the success rate of the jockey, who's my partner, and it's very high. I mean, it's higher than normal or average. And so, I'm not expecting to lose money on any of these productions. In fact, I'm expecting all of them to do very, very well and be Tony Award nominees, probably in multiple categories. So the expectation is that there will be profit, and we're already profitable on our first production, and we're launching the second one. But that's how you look at it. So you increase your probability in any kind of investment by underwriting not only the investment itself, but the team that you're working with. Because I like to say this to investors all the time. I haven't said this for a long, long time. A good investor, like a great investor, can take a bad deal and turn it into a good deal. So you don't want to get involved with people who are not strong investors or strong entrepreneurs. You want to have the right team, because you can have a great business and the wrong team, a weak team, they'll drive the business into the ground or the investment into the ground. You can have a mediocre or average deal and have a great team and can turn that into a great investment or great business.
Yeah, the reciprocal is you can have a great deal and a terrible sponsor or investor, and then they can just drive that deal into the ground, right?
Exactly.
Versus what you just said, having a bad deal. And if you got somebody who's really good in season and have done this time and time again, they could at least maybe get out of it with a small loss or break even. So that leads us to your turnkey business. Walk us through the turnkey model, because when people hear the word turnkey, I think some question marks probably come up. Tell us, what are you doing today?
Well, if you define what turnkey is, first of all, the problem with the word turnkey is I marketed the bejesus out of it 19 years ago when I first started Norada Real Estate Investments, the turnkey real estate company. And today we're one of the largest, maybe the largest, but one of the largest providers of turnkey rental property in the country. We operate in about 25 markets. So we have a very large footprint. It's mostly on the eastern half. I marketed the term turnkey like crazy way back when, and now everybody is using that term loosely, and nobody has like a true definition of it. Mm-hmm. And that's the challenge that we have, is like educating people on what turnkey truly should mean and what it really is. So you have turnkey properties and you have a turnkey real estate investing experience. And what we've tried to do is provide both, and that's what we do. So what is turnkey? Well, a turnkey rental property or turnkey investment, let's call it that, is a property that's in a good market, and we can define that. A good market, a good neighborhood. It's in new or like new condition. It is professionally managed by full service property management. Of course, it's tenant occupied and it's cash flow positive. If you can check all those boxes, that by our definition is a turnkey rental property. And if you have the right team and the right experience in acquiring that property, now you have a turnkey experience in buying a turnkey rental property. There's unfortunately operators and providers out there that don't check all those boxes. They cut corners, whether in the renovations or the construction or the management or whatever. And so, or worse yet, they're selling you properties that are in C- class neighborhoods, mm-hmm. which for most people, that's not where you want to be. That's actually taking on very high risk. And so, it's a disservice to the investor, especially if that's not where the investor should be investing, nor does it meet their investment goals or their investment criteria. You don't want to buy in C-class neighborhoods if your risk tolerance and your objectives, your goals in investing is to have a long-term portfolio that grows in value, mm-hmm. and you want stability. Well, then you should be in B, but ideally B plus A minus neighborhoods, not in C minus neighborhoods. So it's not just the property, it's also the neighborhood, it's the market, and it's the team you're working with. You have to combine all those things together to have a successful investment experience with a successful investment, knowing you have the right team.
Yeah, there were two nuances there that you brought out that I can right off the hand pick out that other companies don't do. And that's, is it in at least like a B plus neighborhood? Because you're like, oh, it's turnkey, we can take care of everything. We've got the property management in place. We've renovated it. We've got a lease in place. Well, that's great. But if you're in a C minus neighborhood, you're probably not going to get a whole lot of appreciation. And that's a big problem, right? Because that's part of the play. And you're probably going to have some horrible tenants that could potentially destroy your property. I see that a lot in the Memphis market, especially. So there's a big difference right there. When you're comparing these turnkey properties to traditional investments like, like stocks and bonds, which seems to be the cultural norm, what are some of the advantages of investing in turnkey real estate versus some of the traditional asset classes that, financial advisors push?
So that's a great question, but I could almost change your question slightly and say, what are the advantages of investing in real estate, residential real estate, or income producing residential real estate, period, not just turnkey. Now turnkey, just provides many more benefits, and it makes it easier and simpler and less brain damage and stress in investing. But you're comparing stocks, bonds, mutual funds, and other assets to real estate. And that's really at the core of your question. And it's basically this: most of those investments you described are predominantly one-dimensional. They either provide an income stream, such as a rate of interest per year, and you get paid, whether it's monthly, annually, or at the end of the term on a maturity date, or they are investments where you're looking for capital growth, capital gains, such as stocks, right? Or if you're investing in commodities or precious metals, you're wanting the price to go up. And that's where your gain is. Now, granted, it's an unrealized gain until you sell, but it's still a gain of one kind, but it's one-dimensional. Real estate is, I want to say, one of the few, if not the only, but one of the few asset classes that provides essentially five pillars, five returns, if you will. They're not all returns. You've got the cash flow. So that's immediate income. And that's measured in terms of a cash on cash return. It's easy to calculate. You put $20,000 down on a $100,000 property, and you're getting whatever a rate of return. It's very attractive. So that's your first. It's cash flow. Second, you have equity. Well, let me say this: your second is not a rate of return; it's leverage. I usually say that as the fifth, but I'm going to say it's the second because it plays into the answer better. Where else can you leverage your investment capital as much as 5-to-1 to buy an asset, control an asset, own an asset, and have 100% of all the benefits of that asset, but only put 20% of the purchase price of that asset into it? There aren't. It's real estate. So leverage is a pillar, and it's a powerful one. And you've got lenders tripping over themselves trying to lend you money if you qualify, right? Because they want you to buy that, because they want to lend on it. So, it's like there's credit out there. So that leverage leads to the third return, if you will. But actually it ties into all of it. And that is the equity growth. So if you have a tenant, whether commercial or residential, in your property, guess what? You're getting monthly cash flow and annual cash flow. Now, that net operating income plays into your returns, your cash on cash returns. But guess what? Every month they're paying down that mortgage, and so every month your equity grows by a little bit more and a little bit more and a little bit more, and that accelerates as your mortgage amortizes. So you're gaining equity even if you have no cash flow and no appreciation. Guess what? Your equity is still growing. That is a rate of return on that property. Granted, it's unrealized, but it's a rate of return. And I've done the math on this. It averages 6.66% per year over a 30-year fixed rate mortgage, just in the amortization alone. So then you've got appreciation. Now we've seen like crazy appreciation over the last 2 years, which is unsustainable and unrealistic. But on average, you'll see 4 to 7%, if you average it out long term. So that's another rate of return, is your appreciation. And those are four. The fifth one is the tax benefits. Now, that's not really a rate of return per se, but essentially it is, because guess what? If you could lower your taxable income, that's immediate money in your pocket. You could call that a return if you want, but if you can keep more of what you make because you've got this phantom write-off from the property, because the IRS allows you to depreciate that property over 27 and a half years, you don't have to spend a penny to get that depreciation, but you get to write off the improvements of that property over 27.5 years. That's great. So that is a rate of return in a sense, because it lowers your taxable income, and that's money straight down to the bottom line, and it goes in your pocket.
Yeah.
So that's it.
There's so many benefits to this that are kind of like shadow income. I mean, everyone looks at the bottom line. Okay, how much is it going to cost me? How much money is going to make me per year? Like your traditional ROI, right? But what you said, it's the cash flow, the mailbox money that you got going in. It's the equity when you first buy the deal. It's the leverage to be able to purchase an asset that your cash goes a long way, as opposed to having to come up with a whole kit and caboodle to purchase it. It's the appreciation that you get in the market, and it's the tax benefits, which is huge. That's the biggest cost of all of our living arrangements, are paying stuff to the government. So if we can take advantage of that, I mean, it's the returns really are crazy. Now, if an investor is looking into getting into turnkey rentals, with your company, or maybe as a market as a whole, what does that look like? Say they want to buy a turnkey rental. Do they have to have like a pre-approval letter come up? Do they have to buy these properties cash? How does that work?
It's really simple. It's no different than a traditional real estate transaction, because it is a traditional real estate transaction. The only difference is you're not buying a home or a second home. You're buying a rental property, a property that you're going to lease to tenants. And that could be a single family home. It could be a duplex. It could be a fourplex. But some of the services we provide is you're connected with an investment counselor. They're going to be your primary point of contact. They're going to get to know you and understand what your investment goals and objectives are, help you define that investment criteria. Once you have that defined, then we can make recommendations on which markets will help you achieve those goals, and then further, which areas or neighborhoods and properties in that market are going to achieve those investment goals. So, hypothetical example might be, okay, you're looking for a market that is, has strong growth potential, but still cash flows. Neighborhoods that are going to be, let's say, a B plus, A minus, because you want kind of that hybrid or that sweet spot between, appreciation potential and cash flow within that market. It might be a 3-bedroom, 2-bath home with a basement. That's typical of what I've been buying in Kansas City, Missouri. And then we'll coach you through it all and hold your hand, introduce you to all the people you need to know, the property providers that we work with, the lenders that provide the mortgage financing specifically for real estate investors, the professional property management companies that we work with. If you need it, asset protection attorneys. If you need it, financial strategists that will help you with tax planning. If you need a trust company like a self-directed retirement account company to roll funds over into a self-directed account, we'll help you with that. Basically, we'll put you in touch with everything. We're the hub of the wheel, and anything and everything you need is a spoke on that wheel, and we're going to just put you in front of those companies and those people. But we're who you lean on. We're going to be your unbiased counselor to guide you through the process over and over and over again until you've built up a portfolio that will essentially give you the financial freedom you need over the timeline that you're working with.
Man, that sounds like white glove service. So you don't just stop at finding deals, renovating the deals for the investors, putting the tenants in place, introducing them to parties that I haven't even heard people do before, like the self-directed companies and some of the asset protection attorneys. That's a new one on me. I mean, this is truly a turnkey in the sense of the word project.
Yeah. And guess what the cost is for that?
I mean, I've got an idea, but I don't want to spoil it. Is it nothing for the additional?
Nothing. We don't charge anything for that counseling. Everything I just described to you is at no cost. No cost to you as a buyer.
Wow.
So
that's incredible. I know a lot of people come from a world where, man, I've got my fiance's, my future in-laws, her brother and his fiance, they're looking at starting like an Airbnb business. And I think she's looking at starting like a business herself in the furniture staging for like weddings. And like their mindset is, hold on, I can just figure it out. I don't need to pay anybody to do anything. I can go figure this out. And so for the audience listening out there, that's like, well, that's great, but I could find much better deals out there if I were to be the one to go and find these deals and renovate these deals and lease these deals. What do you see people who are trying to be the active investor versus the passive investor, what are some of the biggest mistakes or unforeseen variables or obstacles that they're going to run into?
Well, let's define active and passive first. So a passive investor is someone who is not actively doing the work related to that investment, whether it be operations or renovations or acquisitions. An active investor would be, like, as an example, someone who's buying, fixing, and flipping property. Now you're, having to find the property, buy the property, do the renovation work, or bring in a team to do the renovation work and manage that team, et cetera, et cetera. So you're actively involved in the day-to-day process and operations. That's a higher risk endeavor, but that's not investing. That's a business. You're running a business. Investing is when you're putting your capital to work and it's generating a return for you with little to no involvement. And so, that's where I like to be. And that's predominantly who we work with, are, passive investors. So knowing that, even as a passive real estate investor, people still make a lot of mistakes and step on a lot of landmines. And our goal is to help you avoid all of that, because we've been there and we've done that. All of my investment counselors are active real estate investors. They're buying, and investing themselves. Even our operations manager, Kathy, she's actively, in fact, she just closed on a property a couple of days ago. So we want to help you avoid making those same mistakes. This company came to be because I was actively investing about 20 years ago and doing all the right things and all the wrong things at the same time. I made a lot of mistakes, made a lot of money, lost a lot of money. And, those lessons have been translated into, what we talk about and teach today, on our blog, our podcasts, through our investment counselors and all that. And so one of the mistakes I made, and, which a lot of investors fall into this trap, is essentially investing in cheaper properties, like sub $100,000, sometimes $40,000, $50,000, $60,000 properties, because they're cheap and the numbers on paper look great. They have strong cap rates, strong cash on cash returns. Even the cash flow looks good, relative to the purchase price. So it's got a high rent to price ratio. So they look great on paper. But what you start to learn after owning that property for several months and several years is that you have a lot of tenant turnover, a lot of tenant headaches, high vacancy, high turnover, high repair costs. Your tenant demographic is not really who you want in your property. So they create a lot of mess and often a lot of damage while they live there, damage on the way out when they're, the property's being turned over. And then, those are your costs to bear. And so what was good cash flow and good cash on cash return ends up being spent in the vacancies and the turnovers, the renovations to constantly repairing and fixing things at the property. And they're also the most annoying and loud tenants, in these, this demographic of being in low income areas with high turnover, what I, lovingly call C- neighborhoods. Mm-hmm. So, I didn't know that at the time, and I was buying a bunch of those properties. And I learned a lot from the renovation side, a lot from, the tenant side, the management side. And that's just one example of things that we don't want investors to have to deal with.
Yeah, there's a lot of unforeseen stuff when we got to the point where we're flipping, 40, 50 homes a year, and we got up into it, and we had seen all the gurus roll into town and promise, financial freedom from doing this. We didn't realize how much work was involved, the marketing budget, the, contractor management. I mean, there's so many unforeseen things, and, whoever wants to go on this path, there's nothing but growth available to you. And I'm all about that. But if you're a passive investor and you're just looking for passive income, and you've kind of got this idea that, well, maybe I can be active for a little bit and then be passive once it's set up, just know what you're getting into before you start. Speaking of cash flow, I know your company does some stuff with notes. I love note investing, especially on real estate. Walk us through that. If you're an investor and you've never heard of a note before, what would you be looking at, and how does it work, and what's the process like?
Well, there's probably 4 questions in there that you just asked me. Tell me what I miss after I answer your question. So first of all, what is a promissory note? I can't take it for granted that everybody knows what a promissory note is, so let's define that. Promissory note is nothing more than a simple loan agreement. It's two parties, a borrower and a lender, and the lender is just investing money through that promissory note into whatever that note is funding or attached to. It could be a bike, boat, car, a home, as in real estate. It could be a signature loan. I mean, a student loan. Anytime there's a loan, a promissory note is nothing more than a loan agreement. It's just a loan agreement is very extensive. A promissory note is more of a watered down version of the loan agreement, but that's all it is. And it just specifies the terms: who's lending to who, at what interest rate, over what period of time, so the start and end date, and then on that maturity date, what happens? Is the note amortized, so it's fully paid off, or is it interest only, and then it's just one balloon payment where you get your principal back at at the end of that term? That's all a promissory note is, just a loan agreement between two parties. And that loan agreement could be like I said, funding an asset. It could be funding a business. It could be funding a loan to someone else, like a student loan or a mortgage loan. So there's different flavors of it, but a promissory note is a promissory note. It's just a loan agreement. It is one of the most passive investments. It's easy to understand. It's simple. It's like set and forget. Like once you've got the terms established, you sign a note and you funded it. The other party's essentially just paying you on the terms, whether it's monthly or quarterly or one lump sum. So that's what a promissory note is. What was the other part of your question?
Well, so when it comes to these promissory notes, one key factor to take into consideration is the lien position. So are these, first lien positions? Are they second lien? And like, why would an investor, want to make sure they're in a first lien position versus a second?
You're talking in general, like it's obviously
Yeah.
You're talking about real estate notes at this point.
Yeah, real estate notes.
Yeah. So there's two flavors of notes. There's secured and unsecured. And a lot of people think that secured is safer or less risky than unsecured. That's not always true. And I talk about this a lot. So a secured note means it's attached to an asset. So if you, whether it's you or you are issuing a note, but if you have a note that is for a car or a house or whatever, you're going to have a lien on that asset, the car or the house. Mm-hmm. So you can theoretically collect on that asset if the note is in default long enough and take back that asset. And in that situation, you hope that the asset is still worth at least what your principal amount was, and that you can liquidate it, meaning you can sell it or refinance it to pull your money back out. And this is where, secured notes are not necessarily better or safer than unsecured notes, because you're attached to that one and only one asset. But the most common examples is real estate. You have a note or a loan agreement that's providing financing on that house or that property, and then you have another document, which is a rider. Some people call it a promissory note. Some people call it a mortgage. And other people call it a trust deed or a deed of trust, which is the same thing as a mortgage, just depends on what state you live in, or what state you're financing the note. But that is your security instrument. That's what's attaching the note to the collateral, and that's what gives you the ability or the option to collect or foreclose and collect on that asset. So that's the difference between secured and unsecured, and how collateral comes into play. If a note is in default, you hope that the collateral is collectible, in good condition, saleable or refinanceable. And of course, there's some brain damage that goes along with that process, and certainly some time, and almost always some extra money, because you have to hire an attorney or somebody to help you collect.
Mm-hmm. What's the process for an investor who's never done notes before and they're interested in investing in notes? How do they get started? What does it look like? Do they get monthly cash flow? Is it quarterly cash flow? Is it, payments postponed until it sells? What does the cash flow look like on a note?
The biggest answer is like what an attorney would say is, and it's this: it depends.
It depends. Yeah.
Because it depends on, who the party is that you're investing with, what the terms are of that note. I mean, notes come in, 1,000 different variations and flavors. It can be, you can structure the note terms any way you want.
Mhm.
So there's not like a one size fits all, and there's not one standard note. A note is a note. The guts of the note are the same. It's boilerplate, but it's what's on page one that defines the parties. The length of that note, the start date, the maturity date. Are the payments monthly, quarterly, weekly, annually, one lump sum, like a balloon payment? I mean, you can slice and dice this any way, but the gist of the note, like the guts of it, are the same. From note to note. But when more to your question, you need to understand what you're investing in. Like, what is the note for? What are the funds going towards?
Mhm.
And who are the parties involved? Well, the other party, let's say that, like, are you, is it Joe, house flipper down the street, that is flipping houses and has been doing it for a year or two? Or is it a company, that has a established track record and a portfolio of assets or businesses, that, like our company with Norada Capital Management, that's exactly what the notes are. They're not real estate notes, but we issue notes because we have a large growing portfolio of business ventures and business assets,
Mhm.
that form the foundation below the note. And so, there's stability and strength in that foundation, and that's what can service the note, and that's what ultimately pays off that note. So, that's a big difference between, what that scenario that I just painted versus, Joe home flipper down the road, who could be very successful. You could be making money on, short-term 6-month, 12-month notes with
Mhm.
this person.
I want to go ahead,
Yeah,
finish up.
no, it's just, there's just so many opportunities out there. I mean, there are probably 10,000, 20,000, 100,000 notes signed in the US every day. Anytime
Yeah.
you sign a signature loan, a car loan, a home loan, anything, those are all promissory notes.
Yeah, it's very powerful asset class, especially for cash flow. Look into notes more if you're new to this, and I'm sure you've got some information on your website. I want to get to that here in a minute, but I want to pivot to something you told me at the beginning of this call, that you were working on a housing trends type of software that's supposed to provide some very good data across the country. Can you speak to a little bit about that?
Yeah, I'll kind of give you a 30,000 foot overview. So, it is my goal by March 1st, aggressive goal, but my goal nonetheless, March 1st of this year, 2023, to release version 1 of housingtrends.com. And the name says it all. That domain name it's a tool that we use internally, but I want to release it to the public, for a nominal fee per month or per year, to actually see what is going on in all the markets across the country, from the metropolitan area, so the MSA, the metropolitan statistical area, down to smaller and smaller chunks, areas, suburbs, neighborhoods, and as granular counties, and as granular as zip codes. So if you could see what a market is doing in terms of its price action, is it appreciating? Is it depreciating? By how much year over year over year, adjusted for inflation? Is it in a wealth phase or not? Because if you're making a decision, if you're looking to invest in real estate and you want to underwrite your deals, do you want to be investing in a market that is depreciating or appreciating? And more importantly, is well, that's actually the important factor, but is it in a sustained wealth phase, and is it going to continue to be in a sustained wealth phase? Because you don't want to be in a market that is depreciating so rapidly that you're going to be out of a wealth phase, and now prices stand a high probability of going down after you've invested in a market. Same thing is true for when you sell, not just when you buy. If you're looking to either refinance or sell property, even with a 1031 exchange, you want to know, are you near a top of a market? And so, if a market is kind of topped out and now it's starting to decline and weaken, in other words, its momentum is going away, that might be an opportunity to either refinance, to pull equity out and buy more property in other markets using the same tool to grow your portfolio, and or sell those properties ideally through a 1031 exchange, so it's tax free, and take all of your equity and move it to another market that is now, that has come out of the trough and is becoming a strong or stronger growth market. And so it's kind of like you do with the stocks. You reposition your portfolio. You might look at it once a year, every year, and you reposition and rebalance. You can do the same thing with real estate. You can say, look, I've been in such and such a market, call it Phoenix, and it's appreciated like mad over the last 8-10 years, but now it's topping off. And I'm not saying that these are all the factors, of course, but now it's you might want to take your equity out from the Phoenix market and do a 1031 exchange into a strong growth market, like one of the many markets we operate in Florida, which has seen tremendous growth and is still continuing to see very strong growth. So this is how you build wealth a lot faster. So housingtrends.com shows you more than that, shows you rent growth. It's got tools in there to show you population growth, cash flow potential. I can't even remember all the stuff we have in there, but it's really just, it's kind of like looking at things from a macroeconomic perspective without actually being an economist. It just dumbs it down into, red, orange, yellow, green.
I'm scared to ask how you built this thing, the amount of data that's involved in the way to compute the trends. I mean, how long did this take?
Well, this is a tool that's actually been around for, I don't even know how many years. Probably my partner is I call him a propeller head. He's extremely analytical, data geek is what he is. And he's been building these tools. He does it as a hobby. He's been building these tools for over 10 years.
Wow.
So I basically said to him, I said, I could probably build a really good tool around these tools, like a website around these tools, and market it to, our audience and, the people that I know in the real estate space, which, is pretty broad, and we can monetize this, better than he could. And he's admitted that to me, openly. He said, look, I'm not a marketer. I like to work on technical analysis and data and all that kind of stuff. So anyway, we've joined forces and we're still working on it. And my goal is to release a tool like this. But yeah, there is a lot of data in there. And we just released some new tools, which actually are pulling live MLS data across the country, which gives you some additional interesting perspective on how markets are doing in more real time, because it's actual MLS data rather than data that comes out on a monthly basis on each market. So it's actually a little bit more real time.
Wow. We could probably do a whole episode on that. Is it ready, or is there a release date for this?
Well, my goal is, like I said, March 1st.
March 1st. Okay. March 1st.
That's my goal. It'll probably go through, we'll probably have a version 1 of the website up, and then we'll just tweak it and refine it a little bit more. I've set a very high bar for myself to do that, because it gives me about 5 or 6 weeks to get it out the door. But I think I can do it.
Well, we'll definitely have to have you on again and walk through that. I'm excited for you. I'm going to write that down. March 1st is the launch date, and we're going to hold you to it too. So you're going to hear from everybody if you don't launch it by that date.
Well, you're going to kick my butt at the next mastermind event if I don't, right?
That's right. No, it's coming up. Yeah, I'll see you there. I'll hold you accountable. And
Okay.
that website was at housingtrends.com.
Housingtrends.com is where it will live. Right now, it's forwarding to our real estate website, but it'll be shifted over.
Perfect. Well, this has been a lot of fun for the guests that want to get in touch with you, learn more about your products and services. How do they do that?
Well, I guess the best way to reach me and my team and everything that we offer, which is predominantly free, is just our 2 websites at noradarealestate.com and noradacapital.com. And Norada is spelled Norada, Norada Capital, and noradarealestate.com.
Check out Marco's stuff. Head to the website. Check out Housing Trends when it comes out. Till next time, Marco, this has been a pleasure.
Thank you, Brandon. Appreciate it.
See ya.